Well, good morning and welcome to this week's Market Carver. We are just 2 weeks away from my favorite holiday, right? So Easter is always going to matter the most, but Thanksgiving, what a great time for us to be able to sit down, share food, and just great memories with our family. The COVID world seems to be gone. If you miss the news, and I hate the politics, but if you missed the news on Monday morning, Pfizer stock was up over 10%. Most of the others were down about 10%. And it's because they truly believe there may be a pill that really has this and any of the post-COVID diseases under control. Really, really, really has changed the world. That is going to be a big part of what the Market Carver is about today. So there's 8 points on here. I tell Amanda and Adam, we are limited to 5. I just want you to know there are really 8 that I would love to talk about. We're going to start with the Federal Reserve, one of the most important things that's driving the market. Look at the blue line. Now, I'm not going to teach you to read charts. That's Andrew's job. That's Adam's job. And to a large degree, it's my job. But when you see a trajectory change to that degree, you know something has gone on. So the Federal Reserve has dropped the word transitory when it talks about inflation. It has agreed to the fact that we need to increase the speed of tapering. You're going to see more and more of that happening. If you refer back to the Market Carver last week or the week before, either Adam or myself talked about it. The bottom line is when interest rates are originally starting to rise, it really, really doesn't hurt the market. Now, here's the deal that we're really, really in. Remember, the peak of the baby boom was 1957 and 1961. Demographics have been what I have studied my entire career in the 34 years of being here. And I think this kind of really put it out there as quickly as anybody possibly could. So let's break this tweet, because that's really what it is, down. A 5-year tip is a Treasury inflation protected security. So it's what people are looking at that are out there. The most popular target dated fund, rather than just sitting in mutual funds your entire career, having a target dated fund that adjusts as you age may make sense. But the most popular target date fund shifts 20% to Treasury inflation protected securities at age 72. Now, you go back and you think about the demographics, 1957 to 1961. Think about the age of that population. Here's what it means today. TIPS are trading at a negative 1.8%. That means investors are guaranteed to get back $913 5 years from now for every $1,000 they invest today. It really didn't sound like a good trade to me. Really, really think we need to rethink inflation. I am not a target dated fund. I will not fib about that. I've had challenges with them since they came out because I don't think people really understand them. We'll watch people come into our offices that have 5 different target dated funds. It's kind of, what? That's not the way these are designed to work. Somebody asked us about the big boats. Thirdly, we do our best to answer questions. Yes, we do pay attention. We do watch them. And sometimes the big boats get it wrong. Can't go into this slide a whole lot, but what you watched was the yields and bonds start to the 5-year, the 10-year, you begin to watch decline last week. Even as you watch the market increase. Equities and volatility. Normally, these are negatively correlating events. So when you see more volatility, you watch the equity markets drop. We have actually watched that rise occur. Again, a lot of news on that chart. We don't have to go through them all. But here's the deal. Yes, volatility is increased. We're going to talk about that with Tesla in a minute. And the equity market continues to rise. Sentiment is one of the things that concerns Andrew. When you look at breadth and some of the other things that are going on, you know, the breadth is really, really good in almost all areas of the market. Sentiment can become what we like to call frothy. And frothy is when you've pretty much crossed the line. When you've got everybody on one side of the trade, you really have a problem. Ideally, you want them all to be happy about the market. But the reality is, when you're ecstatic, when you're happy, the only thing you can do is sell, right? The only thing you can do is harm the market. And so that's one of the reasons that we watch sentiment in terms of where it is. When everybody is this ecstatic about the probabilities and opportunities, you have an issue that's out there. XLY, so we talk about the S&P 500. XLY is the consumer discretionary part of the S&P 500. It is now, and this shocked me. I have to tell you. Um, XLY at one point in time was 4 or 5% of the value of the market. Included in XLY are Tesla and Amazon. There, it's now the second largest. So you have information technology is the largest sector that's out there, consumer discretionary, then you go into healthcare, and then you go into financials. And usually you watch financials and technology kind of oscillate in terms of who's in charge of what's going on in the S&P 500. This is really, really concerning to me because Tesla is sitting out there, and in the last 10 years has had 11 times when that stock has fallen by more than 30%. So when you do the math, you have the second largest sector in the S&P 500. You have 11 incidents in the last 10 years of falling by more than 30% decline. You can really create some abnormalities in what you would look at in terms of looking at market norms, knowing what to expect. And so many people use the S&P 500 as that benchmark, the holy grail, if you will, in terms of what they watch. It's what they have inside of their 401ks. And when you've got one stock that is that weighted, if you will, and also that volatile, that is a scary thing for a lot of different reasons. Stay at home versus reopening. This goes back to what I shared with you with Dr. Lieb this morning. We really, really, really have watched a lot of tremendous strength in terms of what happened in terms of the market this week. The blue line, I'll just put it this way. The lines at the top, if you can't read them based on the size of your computer, are what we call reopening, right? So you're looking at going to concerts, you're looking at cruises, you're looking at going out to eat, and then you go to the bottom and you have Zoom, which I think we're all tired of. But at the bottom is one of my favorites, is Peloton. Not favorite as a stock. I shouldn't say that. We don't own it. We're not long that. But I've got a Peloton bike at home and was supposed to get on it this morning, quite frankly. When we look at the housing market, this is the next question. These are where people are really talking about the amount of money that is propelling the market because people are taking money out of their homes, the equity. You've seen this massive rise. We've certainly seen it in our neighborhood. I'm sure you've seen it in yours. Here's what I want you to know. It's not near as much as it was in the post-financial crisis that we saw back in '07 and '08. In fact, the majority of money that's coming out is actually to make the house worth more. Those are the home improvement projects. Yes, 27%, about a quarter, are really involved in investment opportunities to be able to leverage the equity that they have in their house. But really, a lot of it is getting their other debt under control. We are at a period of time where we have lower credit card debt. We have lower loans in almost every area. Student loans are always going to concern me probably until I'm way past retirement. My expiration date, as they would say. Hey, if you've already seen this and you enjoy watching this, do not forget to get signed up for your family update meeting. We still have a lot of tax planning to do the rest of the year. If you're new to the Financial Enhancement Group, don't forget to get your next steps meeting set up. Brittany's waiting for your phone call. We're ready to go. The team is there for you. If you want more information or more knowledge, don't forget to go to our radio show. Consider this program. You can find that from 6 to 7 a.m. on WIBC or anywhere you choose to listen to podcasts, multiple other radio stations that are out there. We look forward to being of service. Hey, I wish you guys, if I don't see you next week, a great Thanksgiving.